So I'll do a trade recap on the long that people took earlier, right? So 1 minute fair value gap on NQ, and we got it on ES. It is also a 2 minute. However, they did inverse at the same time. The London low. So we've had the liquidity sweep. We've also got an SMT from like, it was like the 503 candle. So we've got the SMT. We've taken the London low. We've got a reaction of these fair value gaps down here. And one of them is also LFEG. We've had obviously strong displacement up. And we've got a 1 to 2 minute gap. So this trade was a 6 out of 6. So when I was looking at this trade, I saw the trade come about and it's a 6 out of 6. I thought, okay, cool, this looks good. I've looked at the other candles, time frames, and I've noticed, okay, cool, we've got this 2 minute here. This wick in this 2 minute does not invalidate this 2 minute. This is not an accurate target for internal liquidity. Wick needs to be at a reasonable point within the fair value gap for you to be able to target it as internal liquidity, like this, for example. But this has already gone due to this wick that's gone through the gap. So when you see a 2 minute like this, it's so easy for us to just completely retrace off of this 2 minute and respect it just like we did. We tapped into the 2 minute. Fly. We tapped into the 2 minute, we rejected off the 2 minute, and then we've ended up failing. So this is the problem with this trade. This is not valid internal liquidity for you to be able to ignore this fair value gap and target this. And this is actually our take profit point. So as you can see, our internal liquidity on NQ is going to be up here. All right, it's not even a great internal liquidity target. But then this is our target, which is the external buy side liquidity, which is the equal highs on ES as well. So this trade would have been nice if it did come about and we didn't have the 2 minute on ES. It would have been a 30-point move. However, we've got the 2 minute on ES, which we tapped into and we just completely rejected off of. And that is the problem. You can't have a wick this large that is going directly through it and then target that as the internal liquidity. Like I showed you, if we had this, or even if we didn't have this, and we had a new trade come about and we had this is acceptable to target as internal liquidity within the 2 minute gap. But a wick that is this strong and a swing high that's gone through the 2 minute gap is not a valid internal liquidity point. And that is why this trade failed, is because there was a 2 minute that it tapped into and we rejected off of the 2 minute. So that is ultimately why this trade failed, for it to count as internal liquidity within the fair value gap. You can't expect us to completely disrespect this fair value gap and come up and hunt this point of liquidity. That's just not possible. Well, it is possible, but it's just not. It's not a reasonable expectation. It's a good loss to take in terms of journaling it and knowing to avoid that type of loss in the future, but it is a bad trade to take. So it is unfortunate if you did take it. However, it's not the end of the world. Journal it and you will look out for this type of play in the future and you won't take the same L again.